Jerome Powell just walked out of the Federal Reserve building for the last time as chair, and Kevin Warsh has officially stepped into one of the most powerful financial positions on earth. This is not just another political transition or a routine leadership change at the central bank. For Bitcoin investors, this moment carries enormous historical weight because every single Federal Reserve chair transition since Bitcoin was created has been followed by a brutal market collapse. Janet Yellen's transition was followed by an 85% crash. Jerome Powell's first term began before an 84% collapse. Powell's second term was followed by another devastating decline of nearly 78%. Across all three transitions, Bitcoin averaged an 82% drawdown. Now the fourth transition has arrived, and the entire market is trying to answer one question. Will history repeat itself? Or are we witnessing the beginning of a completely different era for Bitcoin and digital assets? Bitcoin is currently trading around $80,832, and on the surface, that number may not seem dramatic. But the price action underneath tells a much more important story. Earlier this week, Bitcoin surged from the $79,000 range toward $82,000 as optimism returned to the market. Investors believed inflation might finally be cooling enough for the Federal Reserve to eventually soften its policy stance. That optimism was shattered almost immediately when inflation data came in hotter than expected. CPI readings showed that price pressures are still deeply embedded throughout the economy, and producer inflation numbers only intensified the fear. Treasury yields surged, rate hike probabilities climbed sharply, and futures markets suddenly began pricing in a meaningful possibility that the Federal Reserve may actually raise rates again before the end of 2026 instead of cutting them. Under previous market conditions, Bitcoin would have collapsed under this kind of macroeconomic pressure. In earlier cycles, a combination of rising yields, hot inflation, and Federal Reserve uncertainty would have triggered panic selling across the crypto market. Yet this time, Bitcoin absorbed the shock surprisingly well. The rally failed, but the structure did not completely break down. Even after multiple negative catalysts hit the market in the same week, Bitcoin remained above the psychologically critical $80,000 level. That resilience is exactly why institutional investors are paying close attention right now. To understand why this transition matters so much, it is important to look at the historical context in detail. In late 2013, Janet Yellen replaced Ben Bernanke at the Federal Reserve, while Bitcoin was trading around $1,100. Over the following 14 months, Bitcoin collapsed to nearly $170. In December 2017, Jerome Powell replaced Janet Yellen, while Bitcoin was near $19,000. Within little more than a year, the market crashed toward $3,000. Then, in November 2021, Powell began his second term, while Bitcoin was near its all-time high, around $69,000. Once again, the market eventually collapsed toward $15,500. Those numbers are terrifying because they create a pattern that appears statistically undeniable. However, when you analyze those periods more carefully, it becomes clear that the chair transitions themselves were probably not the direct cause of the crashes. The real causes were the macroeconomic conditions surrounding those transitions. In 2013, Bitcoin was already inside an unsustainable speculative bubble. In 2017, the ICO mania and excessive leverage had created a fragile market structure that was destined to break. In 2021, the Federal Reserve launched the most aggressive rate hiking cycle in decades, while the collapse of major crypto firms like FTX destroyed confidence across the entire industry. The transitions happened at the same time, but they were not necessarily the true trigger. That distinction matters because the current environment is fundamentally different from any previous transition period in Bitcoin's history. Kevin Warsh is the first Federal Reserve chair with publicly disclosed exposure to digital assets and crypto-related investments. Financial disclosures revealed holdings connected to Bitcoin infrastructure, digital asset firms, decentralized finance projects, and crypto investment vehicles. He has openly described Bitcoin as a sustainable store of value and acknowledged that digital assets are now deeply integrated into the financial system. No previous Federal Reserve chair entered office with that kind of perspective or exposure. For the first time ever, the The head of the Federal Reserve is someone who appears to understand Bitcoin from direct experience rather than from academic briefings or regulatory reports. That changes the psychology of the market in a profound way. Investors are beginning to believe that the historical 82% transition pattern may finally break because the conditions that created the previous crashes no longer fully exist. At the same time, the risks remain very real. Inflation is still elevated. Energy prices remain unstable because of geopolitical tensions. Supply chains continue to experience stress from conflicts and global trade disruptions. If Kevin Warsh adopts a hawkish tone during his first public statements and emphasizes the need to keep monetary policy restrictive, the market could rapidly reprice toward a much more bearish scenario. The probability of future rate hikes would rise further, the dollar would strengthen, yields would climb higher, and Bitcoin could easily revisit lower support zones around $78,000 or even $76,000. This is why the upcoming Federal Reserve communication cycle is so important. The June FOMC meeting may become the defining macro event for Bitcoin during the rest of the year. If Warsh delivers even a moderately dovish tone and suggests that rate cuts could still remain possible later in 2026, the entire market dynamic changes. The dollar would likely weaken, Treasury yields would stabilize, and Bitcoin would finally have the macro support necessary to break through the stubborn resistance level near $82,200. That resistance level has become one of the most important technical zones in the market right now. Bitcoin has tested that area multiple times during the past 2 weeks and failed on every attempt. In technical analysis, repeated rejection at the same level usually leads to one of two outcomes. Either the level eventually breaks explosively once enough buying pressure builds, or repeated failures exhaust buyers and trigger a sharp reversal lower. That is why traders are watching $82,200 so carefully. A daily close above it would likely confirm that bullish momentum is returning. On the downside, the $80,000 area remains critical support. If Bitcoin loses that level decisively, downside targets around $78,500 and $76,000 quickly come into focus. Another major development supporting the long-term bullish case is the progress of the Clarity Act in Washington. The Senate Banking Committee recently advanced the bill with bipartisan support after weeks of uncertainty and political resistance. This legislation matters enormously because it directly addresses one of the biggest barriers preventing large institutional capital flows into crypto markets: regulatory uncertainty. For years, institutional investors repeatedly cited unclear regulations as one of the main reasons they avoided significant Bitcoin exposure. The Clarity Act aims to create a permanent federal framework for digital assets, giving institutions far more confidence about how crypto markets will be regulated moving forward. If the bill eventually passes fully through Congress and becomes law, it could unlock trillions of dollars in institutional capital that has remained on the sidelines waiting for clarity. The market reaction to the committee approval already provided a glimpse of what that future could look like. Bitcoin briefly surged toward $82,000, while crypto-related equities rallied aggressively. Investors understood immediately that regulatory clarity changes the long-term adoption story in a dramatic way. This is not just about short-term price movement. It is about building the legal and financial infrastructure required for the next phase of institutional adoption. At the same time, the ETF market is quietly transforming Bitcoin into a much more structurally stable asset than it was during previous cycles. BlackRock's Bitcoin ETF now controls a massive portion of the spot ETF market and holds hundreds of thousands of Bitcoin. Morgan Stanley's Bitcoin investment products continue attracting inflows, and major wealth management networks are increasingly allowing client exposure to crypto assets. Wells Fargo recently increased its Ethereum ETF holdings significantly, showing that traditional financial institutions are becoming far more comfortable with digital assets even during periods of macroeconomic uncertainty. This institutional demand is creating something Bitcoin has never truly had before: a structural floor supported by large-scale capital allocation. In earlier cycles, Bitcoin relied heavily on retail speculation and leveraged trading. When fear entered the market, liquidity disappeared and prices collapsed rapidly. Today, the situation is different because long-term institutional investors continue buying even during periods of negative news and macro stress. One of the strongest signs of this structural shift is the rapid growth of tokenized financial assets on blockchain infrastructure. Tokenized U.S. Treasuries recently surpassed $15 billion in total value. That may not sound directly connected to Bitcoin, but it actually matters enormously. The same custody systems, compliance tools, blockchain rails, and financial infrastructure supporting tokenized assets are also building the foundation for institutional Bitcoin adoption. Every dollar invested into blockchain-based financial systems makes it easier for institutions to eventually increase exposure to Bitcoin and other digital assets. Another overlooked signal is the behavior of Bitcoin miners themselves. Despite difficult market conditions and post-halving pressure on mining economics, Bitcoin's network hash rate remains near all-time highs. That means miners continue committing enormous computational resources to secure the network even while profitability remains challenging. Historically, miner resilience during uncertain periods has often preceded major long-term price expansions because miners who continue operating during difficult conditions tend to believe strongly in future price appreciation. Whale accumulation data also supports the bullish thesis. Large holders have accumulated hundreds of thousands of Bitcoin over recent weeks, while retail sentiment remains relatively weak. That divergence is important because major market bottoms and accumulation phases often occur when institutional or smart money participants quietly build positions while public enthusiasm remains low. The broader geopolitical environment also adds another layer of complexity to the Bitcoin story. Ongoing tensions involving trade, rare earth supply chains, artificial intelligence infrastructure, and energy markets all indirectly affect digital assets. Rising costs for AI infrastructure and semiconductor production could influence how publicly traded mining companies allocate capital between Bitcoin mining and AI-related businesses. Interestingly, if AI expansion becomes more expensive because of supply chain restrictions, some miners may remain focused on Bitcoin instead of pivoting toward AI infrastructure. That could help maintain strong network security and hash rate growth over the long term. All of these factors combine to create one of the most fascinating macro setups Bitcoin has ever experienced. On one side, there are legitimate risks: persistent inflation, possible rate hikes, geopolitical instability, and the historical memory of previous transition-related crashes. On the other side, there are unprecedented structural advantages: institutional ETF demand, regulatory progress, blockchain financial infrastructure, whale accumulation, and a Federal Reserve chair who appears significantly more open to digital assets than any of his predecessors. The market now sits at a crossroads. If Kevin Warsh signals flexibility on monetary policy and the broader macro environment stabilizes, Bitcoin could finally break through its major resistance levels and begin moving toward much higher price targets over the coming year. If inflation remains stubborn and Federal Reserve policy turns more aggressive, the downside scenarios become increasingly realistic. What makes this moment so extraordinary is that Bitcoin has already absorbed an enormous amount of negative news without collapsing. Hot inflation data, rising yields, geopolitical tension, and a historically dangerous Federal Reserve transition all arrive simultaneously. Yet Bitcoin remains above $80,000. That level of resilience would have been almost impossible during earlier cycles. The long-term picture, therefore, depends less on short-term fear and more on whether the structural transformation of the Bitcoin market continues. The institutional infrastructure being built today did not exist in 2013, 2017, or even 2021. The ETF market did not exist. Regulatory frameworks were incomplete. Major banks were not allocating capital toward digital assets. Traditional financial giants were not building blockchain infrastructure. Those differences matter because they fundamentally change the character of the market itself. The next few weeks will likely determine whether Bitcoin begins a new phase of expansion or temporarily revisits deeper correction territory. Every public statement from Kevin Warsh will be analyzed intensely. Every inflation report, every ETF flow update, every regulatory development, and every macroeconomic signal will influence market psychology. But beneath all of that noise, a much bigger transformation may already be underway. The gradual evolution of Bitcoin from a speculative outsider asset into a permanent part of the global financial system.